welcome to Vedanta Limited full year FY20 results conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. James Cartwright from Vedanta Limited. Thank you, and over to you, sir.
Thank you. Good evening, and thank you everybody for joining Vedanta Limited's fourth quarter and full year results call. On the call today, we have Sunil Dugal, our Group CEO, Arun Kumar, our Group CFO, as well as Ajay Kapoor, our Aluminium CEO. From the start, may I point you all towards our results press release and presentation on our website, including the disclaimer on page 2 of the presentation. Likewise, the primary purpose of this call is to discuss earnings and operational performance. For all questions surrounding the delisting proposal, I'd like to refer you to the frequently asked questions posted on our Vedanta Limited website, and also the presentation on the Vedanta Resources website that goes into further details of the delisting plan. Myself and the rest of the R team will be happy to engage in further questions around the delisting post the call. With that, let me turn the call over to Sunil to start today's presentation. Thank you.
Thank you, James. Good evening, ladies and gentlemen, and welcome to Vedanta fourth quarter FY 2020 earnings conference call. This is my first set of results ever accepting the role of Group CEO of Vedanta Limited, and I am honored to be leading the company which I have been proudly part of for the last 10 years. I must begin by acknowledging Mr. Srinivasan Venkatakrishnan for his leadership to our company for the last 2 years. Under his guidance, we further strengthen our foundation that will benefit our organization long after his departure. We are grateful for his service. And now coming and starting with the year gone by, to describe FY 2020 as a dynamic year is an understatement. The macro environment has been extremely challenging with the impact of COVID-19 pandemic during the final quarter. The virus outbreak, which saw lockdown across geographies, has become one of the biggest threats to the global economy, disrupting businesses and supply chains world over. During these testing times, our priority is to ensure the health and safety of our employees, contractors and stakeholders, while ensuring the business continuity to the extent possible. I will talk more about the direct impact of COVID pandemic, but our responsibility to the communities we work in remain paramount to what we do. With that, amongst other measures, Vedanta set up dedicated 201 crore fund catering to 3 specific areas: livelihood of the daily wage workers across the nation, preventive health care, support to all our employees and contract partners across our plant location as part of its endeavor to join ranks with the Government of India to combat the widespread outbreak of COVID-19. Multiple relief measures were taken across the country through initiatives like providing meals to 10 lakh daily wage earners and feeding over 50,000 stray animals daily on an entire month, to name a few. We also leveraged our existing community program like Sakhi, Khushi, etc. to create grassroots capabilities at village to make interventions sustainable and locally owned. In a move aimed at supporting frontline health workers, doctors during COVID-19 times, Vedanta Limited has enabled mass production of personal protective equipment in Gurugram. The company has imported 23 PP machines recently in collaboration with the Ministry of Textile and has teamed up with authorized apparel manufacturers to roll out over 5,000 PPs per day. During these difficult times, our efforts are aligned to the singular vision of making our communities the state and nation self-reliant and self-sufficient. We are committed to extending all help possible to help alleviate the pain which pandemic has caused. We are closely working with the government alongside our people and partners to emerge from these trying times stronger and better. So now moving on to the operational performance, the COVID pandemic has hit the world hard and us in the last quarter of the year. We have taken a proactive approach to keep our assets and people safe while ensuring optimum operations during these difficult times. With respect to our operations, our Zinc India operations were halted from March 22 and most employees were encouraged to work from home, barring some employees who attended the call for duty to keep production assets safe, including critical care and maintenance. The operations were restarted on the 8th of April, and April itself, we ramped up all our mines and smelters to 40% to 80% of capacity, respectively. In our Zinc International business, operations started safely on 17th April with strict compliance to government regulation and SOPs. Our BMM plant and mining and Hemsburg plant is operational, supported by ore stockpile. In our oil and natural gas business, we have managed to continue our operations at all our three producing blocks with minimum manpower. Oil production had minimal impact as we continue to supply to our domestic crude oil buyers. Gas sales was impacted by around 50 million scf due to lower demand during lockdown, which has been normalized now. Our growth projects, which were the drivers to our near-term volume addition, faced some temporary impact. However, our surface facilities contractors for enhancing liquid handling capacity at MPT and constructing new gas terminals have started ramping up manpower now and activity level while maintaining adequate safety measures. In our aluminium business, all our facilities have been categorized as essential services and continuous process industry by government authorities and continue to operate at current production levels while largely maintaining flattish volume YOY. In iron ore, all our plants and mines operation requiring continuous process and essential services were working with limited operations, and currently we are operating at about 75% capacity. With respect to the steel business, ESL has been operating at 2/3 of the capacity. In order to ensure volume support, ESL tapped the export market largely due to constraints in domestic market. Now, moving on to the key operational highlights for the year. Zinc India MIC production was marginally down 2% and metal production down 3% for the year. Major developments to take capacity to 1.2 million ton per annum now is in place. Zinc International overall production was up 63% YOY. Hemsburg production ramped up to 108 KT. Oil and gas gross production at 174 KBOPD. RDG early gas production ramped up to 90 MMSCFD. Aluminium production at 1.9 million ton per annum. Aluminium cost was $1,690, down 14%. Record production at Lanjigarh, 1.8 million ton, up 21%. Lanjigarh cost $275 per ton, down 15%. Electrosteel, record production of 1,231 KT, up 3%. Sales 1,179 KT, almost flat. In iron ore business, our sales from Karnataka were up 125% YOY at 5.8 million tons. Nandgarh, our flagship CSR initiative, has crossed 1,000 Anganwadi mark and is currently standing at a count of 1250 plus. Continuous improvement as per Golder recommendation is under implementation across all tailing dams. Now, coming to our safety records, we began this fiscal year with a strong commitment to improve our safety performance. While there have been significant gains made across all our businesses, I am deeply saddened by the loss of 2 lives in the fourth quarter of the year, bringing the total loss of lives to 7 in this year. Our LTIFR stands at 0.66 in FY 2020. We have completed the incident investigations for every accident and are taking measures to ensure repeats do not occur. Learning from all incidents are being implemented across our businesses. Occupational health and safety are non-negotiable factors for us, and we are determined to achieve absolute zero harm in our operations. As discussed above, the last quarter of FY 2020 has been a time of global crisis as a result of COVID-19 spread. We are fully committed to the safety of our employees. Our strategy has been threefold: practice physical distancing for all essential work streams, rely on early diagnosis for our workforce to prevent an outbreak, and share knowledge and best practices across our businesses to ensure safe workplaces. While the average footfall at our plants has been reduced significantly, our employees are actively involved in building homegrown solutions to the challenges created by COVID-19. For example, we now have one-touch-based hand washing system which was built by our employees. Additional safety measures in terms of sanitizer, fogging, social distancing through on-ground marking, etc. are also in place to ensure minimum contact. We have also launched a healthcare helpline for our employees in partnership with Apollo Hospital, through which they can teleconsult with a general physician or a psychologist. Now turning to sustainability. Our unwavering focus on operating a sustainable and responsible business continued to deliver results in FY 2020, as well as affirmed by third-party experts. Work on improving the stability and the management of our tailing dams continues. Business units are implementing the recommendations from the audit conducted by Golder Associates in the previous year. In addition, we have updated the tailing dam performance standard and have added a detailed set of guidance notes that all our business units must adhere to when managing their tailing facilities. 2020 also is the end of our cycle for GHG emissions intensity reduction target. We have managed to reduce our GHG emission intensity by 13.81%. This is below our target of 16% from a 2012 baseline and indicative of the stretch target we had taken. This reduction is equivalent to 9 million TCO CO2. We have begun work on setting our next set of long-term GHG reduction targets and will be disclosing those numbers in coming quarters. Our highlights for us in 2020 include 7 million meter cube of water saving over the past 3 years, as well as more than 100% fly ash utilization for second year running. Now coming contribution to the communities. With nearly 190 initiatives spanning healthcare, education, community infrastructure, drinking water, sanitation, sports, women's empowerment, environmental protection, restoration, livelihood, skill development, Vedanta is a force for good in the communities, where we impact more than 3.2 million people across 868 villages. At our flagship Nandgarh program, we crossed the 1,250th Nandgarh mark, and we are rapidly moving forward, reaching 4,000 Nandgarh, which is our target. Now, coming to business unit reviews. First, on Zinc India, mine metal production for the quarter was 2% up 2% YOY to 249 KT, despite operation shutdown from March 22 onwards in compliance with lockdown to combat COVID-19. mine metal was higher YOY on account of higher ore production and better overall grades. Sequentially, mine metal production was up 6% on account of continued improvement in ore grades across the mines. For the full year, mine metal production was 917 KT, down 2% YOY, primarily on account of fewer days of production in March due to lockdown-related COVID-19, and lower grades at Sindeswar Khurd during H1, you may remember, and Kard mine. Integrated metal production was 221 KT for the quarter, down 3% YOY and up 1% sequentially due to lockdown in March. Integrated zinc production was 172 KT, down 2% YOY and 4% sequentially. Integrated lead production was 49 KT, down 7% YOY, while it was up 20% sequentially as Dariba lead smelter resumed normal operation during this quarter. Integrated silver production was 168 ton, down 12% from a year ago due to lower lead production, partly offset by better SK silver grades and improving silver recovery rate, while it was 12% up sequentially on account of higher lead production, better grades, and higher silver recovery. For the full year, metal production was down 3% to 870 KT, and silver production was lower by 10% to 610 ton on account of few days of production in March due to lockdown. Lower lead production in Q2 and Q3 due to temporary operational issues and lower silver grade. Going forward, we do expect a volume growth at SZL given the completion of 1.2 million ton per annum mining infrastructure. Now coming to Zinc International. In our Zinc International business, the total production for the year stood at 240 KT, 63% higher YOY, primarily due to ramp up of first phase of Hamsburg expansion plan. The cost of production was $1,665 per ton, down 13% YOY. The Hamsburg production volume increased from 17 KT in FY19 to 108 KT in FY2020 at a COP of $1,445 per ton. We are working towards improving volumes at Hamsburg with more consistent feed grades and recovery percentage. Work is on full earnest there. The operation at Scorpion mine has been suspended on safety grounds and the mine has been put under care and maintenance. With respect to demand, the key market for zinc and lead concentrate, that is Korea, China, is ramping up now post initial COVID-19 setback in February and March. Major smelting groups like Korea Zinc, Needstar, and Glencore plan to continue normal production at respective facilities in Australia and Europe. Coming to oil and gas, in pursuit of our vision to contribute to 50% of India's domestic crude oil production, we have increased our block acreage by acquiring 51 blocks in open acreage policy, licensing policy OLAP, and 2 blocks in discovered small fields. The acquisition has established us as one of the largest private acreage holders in the country, with a 10-fold jump in acreage from 6,000 square kilometer in August 2018 to 65,000 square kilometer. The PSC block offers a rich project portfolio comprising of enhanced oil recovery, tight oil, tight gas, facility upgradation, and exploration and appraisal prospects. These projects are being executed under an integrated development strategy involving leading global oil field services companies and are on track to deliver near-term additional volumes. During the year, 235 wells were drilled and 45 wells were hooked up. Early gas production facility has been commissioned to design capacity of 90 MMSCFD. Project execution is the key to focus, and bringing some of the gas facilities, EOR, and additional wells related project into fruition will be our key focus and attempting to deliver net of decline volume increase and schedule. We had a planned shutdown at the Mangla processing terminal in February as announced in the last quarter call, which has enabled us to tie in the key surface facilities and carry out activities to enhance the asset integrity. In October 2018, Rajasthan production sharing contract was granted extension of 10 years with effect from 15 May 2020, subject to certain conditions pursuant to Government of India policy on PSC extension. One of the conditions for PSC extension related to audit exception issued as part of routine audit in 2018. The condition stated that if the audit exception results into creation of liability, the same needs to be settled prior to expiry of PSC. These audit exceptions have been replied as per the provisions contained in the PSC and stand disputed now. These were again notified for payment in May 2020 to the tune of $364 million relating to the group share. Total amount was $522 million. Since the audit exceptions were disputed, they do not result into creation of liability. As per PSC provision, we have invoked dispute resolution as per PSC in November 2019 and now initiated arbitration to resolve this. Due to extenuating circumstances surrounding COVID, MOPNG has permitted continuation of petroleum operations in the RJ block with effect from 15 May 2020 until extension addendum is signed for or 3 months, whichever is earlier. In all blocks, our objective is to reduce the cycle time from exploration to production. We have implemented the largest onshore full tensor gravity gradiometry airborne survey in India to optimize time and cost-intensive seismic data acquisition to fast-track drilling. The seismic acquisition program has been initiated and in Assam, and the mobilization of the crew is underway in Rajasthan. Now coming to the aluminium business. In our aluminium business, we saw record alumina production from Lanjigad refinery at 1811 KT, up 21% YOY. Through continued debottlenecking, Q4 FY 2020 saw one of the lowest cost of production at Lanjigad at $258 per ton due to benefits from increase in locally sourced bauxite, continued debottlenecking, improved plant operating parameters, and rupee depreciation. On aluminium hot metal cost of production, we have already achieved our earlier production target, announced target of $1,500 per ton with Q4 FY 2020 cost of production at $1,451 per ton, 20% lower YOY. We expect the cost to be even lower in Q1 and going forward, given stable OMC bauxite supply and lower alumina and coal cost, and the business will make reasonable cash margin even at $1,500 level. In wake of COVID-19 concerns, the outlook for the initial months of FY 2021 was volatile, with some aluminium consumers either reducing or shutting production, a trend seen across geographies, and LME taking a nosedive. Now, however, we see announcements by many industries to resume production in some form at the earliest. The global primary aluminium market is currently at surplus, but we also see LME looking upwards at $1,500 per ton plus in the last few days. We continue to actively monitor the market and will dynamically adopt our product and geography mix to cater to changing market requirement. The Coal Block Allocation Amendment Rule 2020 was notified by the government in line with measures announced to free up coal market over the past few months from intent to auction 50 coal blocks in Finance Minister's speech and the Parliament passing the Mineral Law Bill 2020 to remove captive and use eligibility for coal mining by private companies. The government is also introducing a revenue sharing based bidding model with no technical or financial eligibility criteria. Being one of the largest captive coal consumers in India for power in our aluminium smelters, We see this as a very welcome move in freeing up the coal market. This will reduce our dependency on Coal India and improve the competitiveness of coal suppliers in addition to transparency. We'll actively evaluate all opportunities that these amendments will present to improve our coal security and power cost performance of our aluminum operations. Now coming to iron ore. In our iron ore,
Excuse me, this is the operator. Participants, the line is disconnected. Please stay connected while we reconnect Mr. Dugal. Ladies and gentlemen, thank you for patiently waiting. The line is reconnected. So you may go ahead.
so I don't know where I was disconnected, but I'm coming to iron ore now. In our iron ore business, sales at Karnataka at 5.8 million tons for the year, up 125% YOY due to an increase in production and stock liquidation at Karnataka. Production of pig iron was marginally down by 1% to 681 KT in FY 2020. On Goa, we continue to engage with the government and local communities to restart our operations. Coming on steel, our steel business saw healthy margins for the quarter at $127 per ton, up 132% QOQ. The full year production was up 3% YOY at 1231 KT. With the domestic market showing positive response, we plan to resume our full-scale facilities with more focus on value-added products in our product portfolio and continuously work towards reducing cost. Coming on outlook, we are deferring guidance for FY21 to the end of Q1 after studying the overall situation, and when there is a better clarity, we will come back. Our current focus remains around efficient operations, active management of costs, and capital conservation. As we conclude, I would like to emphasize that this call is to discuss the results of the year gone by, and we will not be taking questions on the recently announced offer from Vedanta Resources to take the company private in this call. The proposed delisting process will be fair and transparent process in accordance with SEBI regulations. The details and respective timings around the postal ballot are on our website, as are all the releases relating to the transaction. Our investor relation team will be able to help with any further questions you may have in this regard. Now, I would like to hand over to Arun for the financials. Arun.
Yeah, thanks, Sunil, and good evening, everyone. I'm on the Q4FY20 financial highlights page. In the current situation, as Sunil pointed out, we stay focused on getting the best out of what we influence, which is volume, cost, efficiency, and claw back as much as possible of the lower LME of Brent. That explains some of the strong performance on cost and efficiency, be it sequential quarter or versus previous year. Again, FY20 over FY19 on a constant price basis has been the best performance in the last 5 years in terms of EBITDA growth, obviously driven by cost and volume. More details in the coming pages. The other key focus is on cash preservation or liquidity, curtail capital spends to high return projects, thus generating positive and substantial free cash flows. This is similar to 2016, where the low price scenario brought out the best free cash flow post capex in the company in the last decade. On this page, you see us maintaining a robust EBITDA margin thanks to the cost improvements, ROC still in double digits, and exiting the year with significant cash reserves, which have served us well in the current quarter as well. The EBITDA at 4,800 crores is better than quarter 3 on a comparable basis, though on an absolute basis is lower. ROC has followed the past trend. The liquidity of 38,000 crores has helped in the current quarter in choppy money markets especially. And as a consequence, the net debt stands at roughly around 21,000 crores, down 21% year on year, with the annualized net debt EBITDA continuing at 1.0 times. As usual, we have a detailed income statement in the appendix, page 24 and 25. However, some key updates on the income statement. On below EBITDA line items, be it depreciation, interest costs, interest income, all are as per expectation and guidance, which was reiterated in quarter 3 as well as during the whole year in the earnings calls. On top of it, the tax charge or the ETR for the year is also at 32%, which is broadly in line with guidance of 30 to 32% that we've been giving for the year, right from the beginning of the year. However, I'd like to help you understand the tax line a bit more. There are 3 things on the tax line which matter this quarter. I'll go in that order. Number 1, as per accounting standards, the 1,700 crores tax charge on the dividend income or potential dividend income from Hindustan Zinc has been created, given the fact that any income from there creates a deferred tax liability for the recipient of the dividend, given that it is knocked off against the brought forward or carried forward tax losses, as they call during the normal tax computation. And the accounting standards suggest that one has to estimate, and hence the charge of 1,700 crores. And you have a better visibility to it given the actual dividend declared by Hindustan Zinc post the year end. Item number 2, in quarter 2 of this year, FY20, if you recollect, we had a deferred tax liability write back of 2,500 crores driven by changes introduced in the tax regime, wherein, as per the future earnings model, deferred tax liabilities would have been released due to the lower rate of tax consequent to shifting to a new tax regime down the line post-exhaustion of the current benefits of MAT asset, akin to several other corporates have taken similar write-backs. These deferred tax liability largely pertain to the tax versus stat carrying value of fixed assets, if I may remind you all. Now, based on the trued-up model in quarter 4, which was actually driven by the newly introduced Finance Act 2000, and primarily the way the future dividend streams get taxed, the trued-up reversal amount for the year stands at 1,800 crores, still a significantly large sum. However, the quarter 4 impact would hence have a charge of 700 crores. Removing the impact of these 2 items, the underlying tax is around 700 to 800 crores for the quarter, though from a full year perspective, both of these offset each other. The item number 3, which is anyways available as separate line, tax credit on the impairment charge taken of 6,500 crores is a third item, which is clearly classified as exceptional as well. Both the impairment-related deferred tax reversal as well as the dividend-related tax are shown as separate line items in the Regulation 33 format in any case. These are all, as you know, these are accounting complexities of deferred tax. Moving on the investment income for Q4 FY20, only point is that versus last year Q4, it is lower given the one-time income we had last year. Hence, the whole portfolio earns around 7% pre-tax income, as guided earlier, no surprises there as well. The same trend would be noticed on a full year basis on that line. Now coming to the impairment, we've added an extra page, as you can see, page 25, I guess. The net of tax charge is about 10,800 crores. This is two broad components. First is pertaining to the oil and gas, which is 9,700 crores, and is primarily driven by price assumptions and some owing to exploration-related write-offs. The policy approach, standard operating procedure for price assumptions, and the variety of other assumptions, which are largely consensus-driven, is completely unchanged as compared to the earlier years. The impact in the Ind AS account will be higher than IFRS, which will come out later, given the lower yearly depreciation charge and the difference in depreciation standards of the two accounting standards. On oil, for consensus assumed in FY20, 21 and 22, at the end of FY18, when the last true-up was done, were all in the mid to late 60s in terms of Brent. The current assumptions all indicate about $20 lower on an average for the next 3 years. And the medium term, which used to be 70s as per our earlier FY18 true-up, is now down to the 50s. This is what the consensus estimates are. VAT is almost same, slightly upward bias. OPEX is lower. OPEX assumptions are lower because we've seen better OPEX, and certain potential lower NPV given the project delays and the delayed realization of the benefits and some of the litigation items. The lower depreciation of the last few years versus the IFRS base are the contributors to this impairment. On the second item, nearly 70% of the carrying value of the work in progress of the copper expansion, 4 LTP expansion, has been taken at about 470 crores after an assessment of the asset recoverability test. These are the two fundamental items. There are a couple of other minor items as well there. And finally, on this page and the detailed income statement, the PSC extension and DGH demand are part of our Reg 33 notes and have been very well covered in Sunil's update that you just heard now. With that, if I move on to the next page, dealing with the sequential quarter EBITDA bridge. As can be seen from the bridge, if you remove the LME impact and the base quarter impact of both together around 20-50 crores, 750 plus 1500, then the EBITDA would actually be up around 10%. One could conclude it is largely driven by the aluminum sector, which, if you recollect, we had highlighted even during the Q3 earnings calls that Q4 costs were tracking lower. We believe this cost performance in aluminum will sustain during the current year, as Sunil highlighted. Again, on volumes, while it shows up flat, it does not have the impact, or rather it has suffered from the impact of the lockdown in March month. Of course, the lockdown was in the second half of the month, but majority of the March sales also happened in the second half of the month, which also confirms that we did exit with higher inventory across, which is now being liquidated in Q1. Again, moving on to the next page on EBITDA bridge versus the previous year Q4, fairly similar story. Excluding the price impact, EBITDA is again higher. And in the appendix, there is a full year EBITDA bridge as well, probably slide 29. EBITDA for FY20 as a whole, as I mentioned earlier, was around 21,000 crores, lower 12% year on year, driven by lower commodity prices, which contributed to a negative 8,000 crores. But more than 50% of the drop in price was recouped to improve costs, albeit some of them are cost deflation as well. Of course, volume lines could have been better, but for the lockdown in the month of March, as I just alluded to a little while ago. Moving on to the next page on net debt. During the year, net debt reduced by 5,600 crores, reflecting our long-term trend of positive free cash flows post-CapEx. Some of the full year sales contracts and customer advances, typically a 4Q phenomenon did not materialize given the market disruption in March and as well as the financial markets. Hence, a negative on the full year working capital. These are expected to be a timing issue, should set itself right during the H1 of the current year. Briefly on the capex page, 2 pages down the line, the numbers are well within the guidance as well. We plan to conserve capital as I articulated earlier, though the formal guidance will be shared during Q1 call. Moving on to the next page on balance sheet. Again, a fairly self-explanatory page. The liquidity for the group remains strong with cash and cash equivalents of nearly 3,800 crores. Albeit the tightness in the domestic capital markets in March due to COVID-19, in the wake of tightened liquidity, the company used its internal cash accrual during Q1 to meet some of the short-term debt obligations, primarily around commercial paper comfortably. We also opted for some selective loan moratoria as applicable, given the preference to conserve liquidity and timing. CRISIL confirmed and held the rating level in this scenario, which is comforting. We are focused on improving the term debt maturity profile, and we believe we will make meaningful progress this quarter, given various discussions in advanced stages with banks and financial sector. Else, the fundamental Vedanta Limited consolidated balance sheet looks fine, with net debt EBITDA maintained at 1. Our investment portfolio is being monitored closely in this scenario, and we don't have any new risks during the quarter. It continues to be CRISIL Tier 1 rated largely. Vedanta had indeed declared interim dividend of 390 per share earlier in the year. Given the need to preserve and build liquidity around operations in this price scenario, final dividend for FY20 was not on the agenda of the board meeting. The board will evaluate further during FY21 as the scenario unfolds. Overall, we continue to focus on costs and efficiencies, cash and liquidity in this scenario. Formal volume and cost guidance can be expected in the next earnings call for us. As we conclude, I'd like to emphasize again that this call is to discuss the results of operations. We will not be taking questions on the recently announced offer from Vedanta, which also is to take the company private. As Sunil articulated, the details of the process, FAQs, timings around postal ballot are all on the website, and our investor relations team will be more than happy to help with any further questions you have in this regard, which may be taken offline. With this, I hand it over to James for the Q&A session.
Thanks very much, Arun. Operator, over to you to start Q&A. Thank you.
Thank you, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may please press star, then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star, then 2. Participants are requested to use handsets while asking a question. Anyone who wishes to ask questions, please press star, then 1. The first question is from the line of Indrajit Agarwal from CLSA. Please go ahead.
Hi, thank you for taking my question. A couple of questions from my side. One, you have just said that you can evaluate the dividend distribution for FY21. We had a dividend distribution policy earlier that whatever dividend we get from Hindustan Zinc will be upstream. Is there a change in that dividend policy, or we still stick to it?
Arun?
Yeah, as far as the dividend policy is concerned, there is no change in the dividend policy. The dividend policy states that minimum payouts when profit is available, both the companies, as well as a pass-through of Zinc dividend as long as it's not a special dividend. Right. So to that extent, this policy will be maintained in FY21. As I mentioned earlier, it will of course be subject to liquidity situations and what the board decides finally.
So in case this dividend from Hindustan Zinc is not distributed, the deferred tax of 1,700 crores, does that mean actual cash outflow, or it can still be adjusted against the other group income?
No, it has nothing to do with whether the dividend gets distributed or not, simply because any dividend income is offset with the tax shields carried forward, post which ATM comes into play after all that gets exhausted. So till such time this is a normal accounting. It has nothing to do with whether you distribute it or not. Thanks.
Sure. Second question on your capex on slide 26 of the presentation. The $1.35 billion CAN capex. So how much is avoidable? How much capex do you have to actually incur to maintain production YOY, and how much is that this can be avoided to preserve liquidity?
So, I will take this question. So, in the current context, it is very clear that the capex discipline has to be maintained. So, whatever the volume which will be delivered in the near term, only those capexes will be taken up, and whatever the capexes which are in the pipeline, like 3-4 projects are there: tight gas, tight oil, the liquid handling facility, the polymer feeding facility. So these are 4-5 capexes which are in pipeline along with Rava. So these capexes only are getting completed, and the other capexes are being re-evaluated in the current context of Brent prices and other viabilities.
Sure.
And if I may just add a line broadly, the unspent that you see on, also the unspent you see on page 26, the biggest project is ASP. So we, as Sunil said, we'll evaluate it in the course of time, and we'll take it up only if it is absolutely feasible and making a lot of return at low oil prices.
Just 5 projects are in pipeline: gas, liquid handling facility, tight oil, offshore Rava, and MBA infill and polymer.
Sure. Thank you. Last question is on slide 35, your aluminum profitability. The power cost over there has dropped sharply by about $140 per ton QOQ. So if you can shed some more light in terms of what was the coal cost, how much of this reduction is sustainable, etc.
So Ajay will give you the detail, but of course the drop in cost is the basic realization of the linkage coals and better availability of the mix. So these are the basic reasons, but Ajay, you may like to add.
Yeah, sure. Thank you, Sunil. So basically, we've had a good mix of both coal. What Sunil was mentioning, the coal availability was better at a lower cost also. So that gave us about $55-60. Additional to that, performance technical parameters, including the PLF of the plants, that also gave additional about 25-30. And the remaining came from RPO, where earlier we had much higher percentage. But after the Odisha government's notification, after Ministry of Finance, Ministry of Power notification, so now the RPO for Odisha was pegged at 3 and Chhattisgarh at 7.5%. So that also gave additional $30-35. And most of it, the RPO, the technical parameters are sustainable. Coal, in fact, in Q1, we are actually seeing the benefit of even lower procurement prices. So, which I think also Arun mentioned and Sunil also mentioned. We believe that will help us in a much better cost of production going forward in Q1 and beyond.
Thank you. That's all from my side.
Thank you. The next question is from the line of Amit Dixit from Edelweiss. Please go ahead.
Thanks a lot for taking my question. I have a couple of questions. The first one is on impairment in oil and gas division. While Arun explained, in detail that what led to the impairment, just wanted to understand, because it is quite peculiar that none of the global peers have taken such kind of impairment, including BHP in their latest production report. They have not indicated anything. In fact, they have said that price outlook will get better as we go ahead. So the question is that how much of this impairment is related to price, and is there any chance of this getting reversed in subsequent quarters if the outlook improves?
So Arun, you may like this.
Amit, thanks for that. Amit, thanks for the question. So fundamentally, let me make a few distinctions. One, global players, there could be multiple assets and multiple headrooms there. Here it's broadly the Rajasthan asset, as you know, which has the maximum value. Of course, there are a few other assets like Cambay and Rava. And second is that in a language that you would appreciate, it's almost mark to market in a manner of speaking, simply because This is the fourth time in the last 6 years that you've taken an impairment. Twice you've taken an impairment charge and once you've taken an impairment reversal. And hence, any sharp movements in price or reserve, you would have higher likelihood of impairment in Kane rather than probably other companies which may not be strictly comparable. At least at the asset level, it might be comparable. Now, your second sub-question there, how much of it is really price? You'll realize that the $20 number that I gave you is lower price assumption on an average compared to the earlier one when they stood up in March 2018, as pertains to FY21, 22, 23, which is the go-forward period and of course into the future. Simply a 3-year impact on $20 will itself give you a number of $700, $800 million. With that, you add the NPV, you add the exploration bit, etc. You almost arrive at your number. So an overwhelming majority of it is price-driven is the point I was trying to make as I explained the impairment. And the third sub-question that you had here, of course, the possibility of write-back is very well there, but obviously in our accounting world, as you know, the threshold for write-back is far higher than a threshold for a write-down, and as is the common language, they call it conservative. And to take you back to the memory lane a couple of years ago, there was a write-back, but that was very, very clearly led by addition of reserves. Physical reserves got added thanks to the EOR programs and the other capex, which are related to the capex question that was raised by Inderjit. All those capex items created reserves, so we wrote it back actually. Right? Otherwise, possible, but thresholds are definitely normally higher. I hope that helped answer the question.
Thanks a lot for this answer, quite detailed one. The second question is on oil and gas production itself. You know, despite investing close to $1 billion in last 2 years, we have seen that oil production has come down from 200 KBPD to 160. Of course, this quarter there could be one-off because, you know, you had shutdown at Rajasthan block. However, in the last presentation, we had given guidance of 225 KBPD of exit capacity. And the number of wells hooked at the end of H2 were 90. However, we see just 75 at the end of H2. So, how long do you think will it take for us to achieve this 225 KBPD that we guided at FY20 exit?
So, the lesser production was a combination of the decline and the new projects and the liquid facility which was to be upgraded. So as the water cut goes up, you have to feed more water and polymer. So if the liquid facility is limited, so that means you have to cut down the production. So until the new facility is hooked up, you will see the decline faster. So, but as I said that there are 5 projects which are coming up, which are almost nearing completion now. And by this time, some of the projects might have already got completed if the COVID would not have happened and the labor would not have run away from there. And some of the equipment which were held up in Italy, China, those would have come in time. So, but there was a bit of the delay. Some of the projects which were to get completed last year got delayed for some reason or the other. Now we are in the process of getting these projects completed. So gas, which was from where we got the early supply of gas, which is contributing to 20k barrel per day. When this project will get commissioned in Q2, this will contribute additional 20k barrel. Liquid handling facility, as I just said, that how this will add. This will add to a volume of around 10k barrels. So this will also get completed in Q2. Tight oil is the another project which is getting hooked up. Will get completed in Q2. This will add around 10k barrel again. Offshore Rawa, this project is about to get completed in a month or two. This will add 5k barrel. And MBA infill and polymer facility which is being done by the Halliburton, where all wells are done and the surface facility is about to get completed. This will get completed in the next 2 to 3 months time, again early Q2, and this will also give you 10k barrel. And all this addition, including the base volume, we are confident that the exit volume this time should be definitely between 220 to 240k barrel.
Thanks, Mr. Duggal, for a detailed answer. That means by Q2, and we should see a tangible increase in oil production. This is what you're trying to say, right?
So from Q3, you will see the tangible increase in production because the commissioning will happen, the project completion will happen in Q2 in stages from month to month, and then the ramping up of the facility has to happen and stabilization of the facility. But definitely, this volume will start ramping up from Q3 onward. Some indications will also come in Q2 also.
Great. Thanks for the detailed answer. I have few other questions, but I will get back in the queue. Thank you, and all the best.
Thank you. The next question is from the line of Amit Murarka from Motilal Oswal. Please go ahead.
Hi, good evening, everyone. So I just wanted to understand the aluminum cost reduction. So can you help break up that cost reduction in terms of how much is coming from the fuel cost, how much is from the lower cost of alumina, just to understand basically what is related to the commodity price deflation and how much is structural reduction?
So you're right. The cost reduction is a combination of alumina, which is how much of sourcing from the local Odisha or the contribution of the Lanjigad or the purchase alumina and power. And power also, Ajay said that there are various factors and the carbon. But Ajay, you would like to give the detail?
Yeah, sure. So Mr. Duggal has already mentioned. So essentially, on one hand, as Mr. Duggal mentioned in the beginning, Lanjigad achieved its lowest cost of production in the last quarter, close to 258. And then, so that is one reduction. Second, of course, the API index itself, alumina index fell down, and along with the LME, which you've also seen. So that both added together gave us a good alumina cost. Coal and power I already handled. I think the answer remains same. Where there were three levers. RPO was one, which is structural. Coal also I would say structural in the midterm because a lot of good coal and excess coal is available now. And third, of course, plant reliability also was much better in the last quarter, which I think will continue. On top of it, the commodity prices, things like CP coke, CP pitch, they were also on the lower side, so that also helped us. I believe that should also remain more or less in the same range bound. That collectively, and we are also running commercial and manufacturing excellence programs, which I also spoke last time. They are also yielding very good results.
Just to clarify one thing, that the plant availability reduces the power import, which also makes a lot of difference.
Okay, sure. And on the Rajasthan asset, the block, so the 3-month extension has been given now or is in operation now. But how does it resolve itself? Like, let's say if the PSC, the extension signing is not done at the end of these 3 months. So will you continue to get this extension until the time the extension happens? Will your production sharing and the investment multiple with the government remain the same as it was in the earlier PSC?
So, as we told you that the addendum is to be signed, the PSC extension, when the PSC extension was given, there was a principal agreement which was reached between us and the government that this extension of PSC will continue and there will not be any strings attached to this. So like whether the earlier demand has to be settled. So we have principally agreed, and based on that, they have taken up the approval. And now this is lying with the Law Ministry. We will get approval from Law Ministry any day. And my own belief is that in the next 1, 2, 3, 4 weeks, this should be signed.
Sure. And the production sharing is going up to 60% as part of the extension, or that is still under discussion?
No, it is we are signing the PSC as per new policy, which is 50%, and the investment multiple recovery remains same as earlier. But that is a separate thing that we are disputing with them that it should remain at 40%.
Okay, sure. Thanks.
Thank you. The next question is from the line of Ritesh Shah from Investec Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. My first question is for Arun. Sir, how should we look at the debt maturity profile and the cash flows into FY21? I understand on one of the slides we have given 9,100 crores. Sir, how much is the outstanding commercial paper, and how should one look at cash flows for this year? Looks like it's like walking on a tightrope.
Arun?
Not really, because I think the outstanding commercial paper is probably down to about 3,000-4,000 crores at this point of time. Very, very manageable levels, right? Even otherwise, the credit supports a higher level. And secondly, in terms of refinancing, broadly, we believe that in the next, with some luck, 30 days, if not 60, 70 days, we should be done with the majority of the refinancing for the year. So we are comfortable out there. And as I alluded to in my talk track, we are in advanced discussions with some of our key banking partners.
Okay, so basically we are looking at refinancing of nearly 12,500 crores this year. That's something which is comforting for us despite the tightness in the credit markets. Is there a fair way to understand it, or should one look at a significantly lower capex? I understand we are not giving guidance, but some color over here would be quite useful.
So on capex, sorry, go ahead, Sunil.
No, you go ahead. I'll add later. Yeah.
On capex, of course, we have not given guidance, but all I can point you out to is the trend chart that we normally place, which shows what is the guidance at the beginning of the year and where did we land up. If you see, we're always much below our budgets. We absolutely conserve and would like to deploy it only where there is an immediate link to the volumes, as Sunil articulated earlier. And broadly, if you see, Zinc spending program is almost done for the 1.2, and it's really only the 5-6 projects in oil which are at advanced stages, as Sunil said. And anything new, we would have to look at and evaluate sharply, even though all our projects, we have said earlier, even at 40 Brent, and assuming a higher profit petroleum share, are still producing well above 30% from an IRR perspective, which, as you can appreciate, is much higher than our cost of capital. So from that aspect, you may be short of a number of guidance in this call, but I think you have enough comfort in terms of understanding our minds that it will be rationed and it will be absolutely closely monitored.
Right. Sir, honestly, given your commentary, it looks like we're in a comfortable position. And as a minority, definitely at Vedanta level, one would be looking at a dividend payout, at least what has transpired through HZL to the parent. Is it something that one can expect during the year going forward? Any commentary over here? Or is it something one will have to look at it at a later stage based on cash flows?
No, feedback is quite valuable, and we will definitely share it in general with the board when we meet. Thanks.
Right. Sir, my second question is for Mr. Duggal. Sir, any update on the Hindustan Zinc's second call option? I understand the CBI file is still pending. Any particular reason over here for the delay, and are there any timelines that one should look at?
While I would not comment on anything which is going on, but one thing I would like to clarify at this point of time, that the CBI file is closed. The closure report has been filed by CBI and it has been handed over to the court.
Okay, fine. That helps. Thank you so much.
Thank you. Ladies and gentlemen, we take the last question from the line of Rajesh Lachani from HSBC. Please go ahead.
Thanks for the opportunity, sir. So my question is with regards to the employee cost. We have seen that in this quarter, the employee cost has reduced substantially compared to prior year as well as sequentially. Just want to understand the reason, and is this the new norm, or should we see employee cost rising from the next quarter? That would be question number one.
Maybe that's sort of a very sort of a technical financial question. Let me quickly address it. Right, we do always true up certain performance bonuses related provisions simply because we do know the numbers by the time. So you could say it broadly relates to that because a lot of the component is variable in nature, right? So with performance comes bonus. With this low price environment, right, you can understand that some of them may have been better.
But just to build on what Arun has said, in the current context, actually, we have risen to the occasion and we are proud of what we are doing in terms of how we are liquidating our stock, how our capacity utilization has gone up. We are almost operating at 100% of volumes. But on cost, I may tell you that we have redesigned ourselves and we have divided the total cost into the various buckets, in 7-8 buckets. So, and we have made the Mancom in each organization where the 3, 4, 5 people are there who are the key decision makers who may meet on a daily basis to make the decision. But on the cost, we have divided this into 8-9 buckets and we have given the ownership of that cost bucket to each senior individual in each company. And these all costs are reviewed in the war rooms on a daily basis. And I am very proud to tell you that we have decided ourselves that we will try and endeavor to protect our margin, what was there in Q4 and Q3 last year, even in this low cycle of commodity prices.
Understood, sir. And sir, my question to Arun would be, on slide 21, we have mentioned ROC of 11%. So just want to understand, this 11% is after the impairment, right?
That's right. So, and this would be an average capital employed for the year.
Right. So this is post impairment. And Arun, if we remove Hindustan Zinc from this, can you let me know what will the ROC for the remaining businesses?
I don't have the split ready hand, but we can definitely work it out and give it to you. The good news there really is that aluminum business, as you saw in the appendix, at post-tax, let's say, EBIT post-tax, as a percentage of capital employed, is starting to turn a nice positive. So that should, if that sustains, as we believe it will, that should help pull the ROC upwards even in a low price scenario. Of course, as we speak, the prices are looking up. That's a different matter altogether. But I think there's some good tailwinds out there one should expect, especially in the light of the commentary that Sunil gave in terms of protecting the margins and pulling the costs down in this scenario.
Understood. Arun, but my question was more about a structural thing. So we have been talking about considering only those projects which have high IRR. We talk about 20%. And if we remove Hindustan Zinc, then the ROC for the remaining business, even in the years when the commodity prices were relatively much better, the ROCs for the remaining business has been much lower. So just wanted to understand, isn't there some issue with the capital allocation in previously, as well as, shouldn't there be a review of the capital allocation strategy going forward?
I think it's a good question, but a lot of it is history, as you mentioned. If you look at the last 3-5 year scenario and take the capex spend from an allocation perspective, it has gone into sectors and areas and projects where the IRR is much more than your cost of capital at that point of time. It's a different matter that prior to that you got the returns desired or got the returns a little later than what was planned. Right. So that's broadly where it is. If you look at all the projects of oil, which will come into fruition this year, the IRR would be above the cost of capital. Zinc, as you know, is always, even at a low zinc price, it's about plus 30%. And we have not spent anything in aluminum in the last 5 years as such. So it's been a story of making structural corrections to enhance the incremental ROC, right, or incremental yearly ROC so that the overall value goes up. So that's been sort of the efforts in the 3 big sectors. And of course, if copper comes back and Goa reopens, your numbers will automatically start looking up.
Sure. That's quite elaborate answer. Thanks a lot.
Thank you.
Thank you, everybody. Thank you, everybody. On behalf of the entire Vedanta team, thank you for dialing in today. And we'd just like to say, any further questions, please don't hesitate to contact myself and the rest of the investor relations team. With that, let me pass it back to the operator to close the call. Thank you.
Thank you very much, sir. Ladies and gentlemen, on behalf of Vedanta Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.
Playback is complete.